I want to start with the base foundation that historically speaking is that the poor buy things, right? The middle class, they buy liabilities. The wealthy buy assets, okay? And so this, going back to my personal experience, this whole idea that you need money to make money isn't necessarily true. And if you buy just things, well, they're just things. They have no value whatsoever. And then if you buy liabilities, which is what Keeping Up with the Joneses is all about, right? Then at the end of the month, you either break even or you have less than you're bringing in. And that is your net worth, right? That is your assets equal the liabilities plus your equity. So your liabilities are really, really high.
Hello, everyone, and welcome to another edition of Thrive and Achieve with your host, Dr. Matt Markle. Thrive and Achieve is the only podcast where professionals help professionals to succeed in career and wealth. Now, here's your host, Dr. Matt Markle.
Hi, everybody, and welcome to Thrive and Achieve, the show where professionals help professionals thrive in their careers and achieve financial wealth. I am super excited today to welcome Mr. Mike Clark to our show. Mike has been a friend, a colleague, a co-investor, and an advisor to me for many years, and I'll tell you, not many people know this stuff as well as Mike does. Mike has been a successful industry leader. He won awards for his leadership at companies like Johnson & Johnson. He's also a wizard at capital raising over $42 million, which I'll tell you isn't easy from someone who's done capital raising. That's not easy. Today, he is a financial advisor for high net worth individuals, bringing in this really cool concept of creating a digital family office that can oversee the very interrelated aspects of wealth preservation, wealth growth, tax optimization, estate planning, and more. It's really a neat thing when you get all those working together synergistically and symbiotically. Mike, it is an honor to have you here. Welcome to Thrive and Achieve.
Matt, one, thank you for all of that. It's always weird when people say good things about you, but super appreciative of you asking to be here. Thankful for being here, and let's create some value.
Awesome. Okay, let's get started. Mike, tell us a little bit about your professional journey, how you got to where you are today.
So Matt, in a snippet, I didn't come from money like a lot of people. And I say that because everybody's like, well, if you don't have money, you can't make money. So I didn't come from money. And when I started making money, when I was working with Johnson & Johnson, people were say, hey, you got to do things about taxes. And I'm like, I don't even know what taxes are. Like, what do you mean? And so I got the CPA. And then I was introduced to a high-level financial education that was like 6 or 7 meetings. And it was, how do you structure entities? What is life insurance? How do you structure health insurance? How do all of these pieces work together synergistically instead of opposing each other? And so that was really an aha moment for me, Matt. And that's when I walked away from Johnson & Johnson to become an advisor. And that from there started getting into raising capital. And then now what I do with Protection Point Advisors and building these digital family offices. It really came down to just education and learning that there is more out there. I just have to be a better steward and learn what tools are available for me. And then I started teaching others.
That's fantastic. You never learn it as well until you start teaching others, right? Because then you have to put everything together. Was there like a defining moment in your career or in your financial life that really shaped how you think about success?
Matt, that really came down later, I guess, in my mid-career when I was raising money for business owners. And I really noticed the disconnect between professionals that that are working with that should be operating together. Meaning the CPA, that's not my job, that's theirs. The security exchange attorney, that's not mine, it's the business attorney's deal. You know, I don't, and then you've experienced this, Matt, like there's the tax person doesn't get involved until there's a liquidity event. Well, all of that needs to be planned up front. And so that was probably the biggest turning point in my career, is that very, very smart people and people that look extremely talented on paper still work in silos. And it's a disadvantage to the person that they're working with, whether it be a business owner or an individual. It's still that disconnect should not be happening in today's environment.
That's awesome. It's like if you go to one doctor because you've got a knee pain, and you go to another doctor because your stomach's upset, and the knee pain doctor is putting you on ibuprofen, and the stomach doctor is saying like, don't take ibuprofen, right? It's like because there's this that's what I think what is really really exciting about what you're doing now is you're stringing together all of these very interrelated activities which are typically done in silos, and that's done at the individual level, and that's done in the corporate level as well, through all the examples that you mentioned there as well. I've seen it where you have things optimizing locally and not optimizing globally.
Right. And I get it, Matt. I mean, we have this psychological thing that as humans, we grew up, don't share, don't cheat, don't plagiarize, don't talk to strangers. I mean, all of these things for the longest of times. And then when we get into the professional world, at some level, we're told to go network and talk to strangers, go create strategic partnerships, and they don't know how. And so nobody taught us as professionals how to work and collaborate with each other for the benefit of everybody. So we want to do it, but then we just kind of cower in the corner and be like, that's not my job, that's theirs, sorry. And that we've got to get out of this paradigm if we want to really create value in whatever field we're in, but especially in the financial world, we have to do it. We have to start working together.
And so for you, the metric of success comes down to some aspect of being able to solve holistic problems as opposed to, I don't mean to put words in your mouth, but solve holistic problems as opposed to solving a niche area and adding a specific value in just a niche area.
Right. And so when you, and just to clarify, the holistic side of it which is a completely different conversation, but you know this as running companies. There are 100 things that are happening financially within a company. And yet you can't have 50 professionals not communicating, discussing those 100 aspects of your financials, right? And so when I look at it holistically, my core business is financial advisory, money management. But if I look at any individual or any business, I'm literally at the bottom of that list. There are dozens of things that need to happen before I actually start doing strategies, right? And that's where we have to get to.
Awesome. That is amazing. Really, 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 really insightful. I think so many people don't see it like that, and I think you've cracked the code. You've cracked the code on how to really make this.
I think so. I mean, and we do webinars. I mean, like, this is why we engage in conversations like this, Matt, because I don't know what every professional does, right? And so I need to know how they service clients. We can talk about that in a little bit, what their lane is, and then show them how to stay in their lane and still create as much value as possible. But a lot of professionals, unfortunately, don't want to engage in that process. So that's why we try to work with those that see that vision and feel like we have cracked the code on something. And that's what we really try to strive to do.
Yeah, I love what you're doing with Protection Point Advisors, by the way, also. I remember the first time you and I talked about that, it was very much focused on primarily we serve as an educational tool, and then we do money management and financial planning and the whole digital family, all that sort of stuff as well. But we are primarily a source of education, and that's just so important. That's why we do Thrive and Achieve here. It's professionals helping professionals, right? Because no one's got the answer. No one knows everything. If there's one person that knew everything, well, they'd be too busy trying to answer everybody else's questions for it to actually work anyways.
Right.
So that they wouldn't be, they're not really adding value because they decided to like one person's question at a time.
Stay with us. We'll be right back to Thrive and Achieve. But first, have you signed up for the Anti-Preneur Insider? This valuable resource provides one actionable tip on how to thrive in your career and one on how to achieve financial success. And it's free. There is so much noise out there today that it's really hard to see the signal in it. That's what the Anti-Preneur Insider does. It cuts through the noise to provide you the focused information that you need in a quick and entertaining email. Get it delivered to your inbox every Monday. Just sign up at antipreneur.com. That's anti-preneur, ANTI-PRENEUR.com.
Welcome back. Today we're talking to Mike Clark, successful business leader turned financial advisor to high net worth individuals. Now we're going to be going deep on one of my favorite tools to understand what your financial situation is today and quantifying that. And that tool is called the balance sheet. Okay, Mike, you're the expert.
Look, I think what is a balance sheet?
What is a balance sheet? What are we balancing? So back in macroeconomics class, we talked about guns and butter, right? Are we balancing guns and butter? What's going on with this balance sheet?
So, I mean, what's just funny when we talk about going back is that, this whole double entry, checks and balances, debits and credits, right? And really, the balance sheet is an extension of that. How does your life balance, right? Your assets equal liabilities and equities. Okay. Now, the interesting thing about that question, Matt, is that there's two perspectives of that. There's the balance sheet of a business and there's the balance sheet of the individual, right? So I guess my question is which path do we want to go down right now? I mean, first.
So we're going to be talking about the individuals. That's the thing. But since the term kind of originated in double accounting business, so that's the history lesson on that is probably pretty good. But the focus of this is on individuals, is on the professionals.
So then in that case, Matt, and I've thought about this, and I want to start with the base foundation is that historically speaking, is that the poor buy things, right? The middle class, they buy liabilities. The wealthy buy assets, okay? And so this, going back to my personal experience, this whole idea that you need money to make money isn't necessarily true. Right? But the idea is understanding the cash flow coming in, at some level, your equities, and the cash flow going out, your liabilities. And if you buy just things, well, they're just things. They have no value whatsoever. And then if you buy liabilities, which is what Keeping Up with the Joneses is all about, right? Then at the end of the month, you either break even or you have less than you're bringing in. And that is your net worth, right? That is your assets equal the liabilities plus your equities. So your liabilities are really, really high. And so in order for just the normal individual, there are so many tools, Matt, out there that do this for you now, right? Rocket. I saw another one today called Monarch that you put in your cash flow and it'll tell you where you're spending money. And I don't believe in that whole latte factor, right? In the sense that if you buy a latte every day, you're going to go broke. Okay, it's not the best for you financially or for your health. But you're never going to save your way to wealth. I mean, the general population has to get out of this mindset of buying liabilities, just buying things, right? They have to get into the mindset of follow the money buy assets. And that could be anything, Matt. We'll get into that as well, right? But find what you're passionate about, find what you have knowledge in or learn something about, and then start investing into those assets, be it real estate or crypto or whatever that case may be. But you have to define what that wealth plan looks like for you, which I know that's going to be later as well. And then figure out a path or a financial plan to get you there so your net worth is not zero. You start to creep up that net worth because your assets and your equity outweigh the liabilities that you currently have, which is the debt that most of us carry.
That's amazing. That is amazing. What was that quote again? The poor buy
things, the middle class buy liabilities, the wealthy buy assets.
That's amazing. That's amazing. So I love the equation. The way accounting people talk about it is assets equals liabilities plus equity, right? That's the way that accounting is. For me, what I like to do is to flip the liabilities to the other side. So assets minus liabilities equals the equity you have in your household. So basically, if you take all your assets and all your liabilities, and we'll talk about what goes in each of those columns in a little bit, subtract those, that is the value of the corporation of your household. And when you think it like that, then one of the things I see a lot of people doing is they might be making really good money. Like you said, they're the middle class. They might be making 100 grand, 200 grand, 300 grand or so a year. But if you look at the equity in their household, which is again, take their assets, which we'll talk about in a second, take their liabilities, we'll talk about in a second, and subtract the equity they have, the worth that they have, it's really not all that much. And you
Right.
think of like, oh, this is a person who's been making, oh, a tenth of a mil, quarter of a mil, something like that for years and years. What do they have to show for it? Well,
A garage full of things,
they have a
Matt.
garage full of things. They have a Lexus, or a actually, I've got a Lexus, so I don't use that. That's a very economical car. They have a Tesla, and they have a
Well,
Model
no, but
S,
they
and
have, and this is the thing, and I get, there's all kinds of nuances to this. There are people that don't like to travel the world, so they buy a camper. I get that. Like, I understand those two principles. But at the end of the day, if you sit down, to your point, Matt, if you sit down and your net worth is near zero, right? And that's being a little facetious, but you walk into your garage and you've got a side-by-side, two four-wheelers, a couple dirt bikes, a camper out back, you have to start to look at, okay, well, I don't have a lot of net worth because I have a lot of liability sitting in this garage. Because none of these are appreciating assets. None of these are gaining value as time goes on. Every one of them is depleting their value, depreciating as time goes on, including that Lexus and the Tesla. And so there's all kinds of nuances when you look at financials, personal financials, is that, like, personally speaking, and this has been documented for years and years, I don't know a reason why you'd buy a new car. Like, you walk off the lot and it's worth less than you paid for it. So buy a 2-year-old car. So there's all kinds of like personal things and ego that get into it, psychology of money. But if you walk out in your garage and you see all of those liabilities, you can't be upset that you're living paycheck to paycheck.
which actually 1 out of 3 households making more than 200 grand a year lives paycheck to paycheck. When I did my TED talk recently, doing a bunch of research for that, that was mind blowing that 1 out of 3 households making over 200 grand a year lives paycheck to paycheck. Okay, let's dive into some of the details. What are some of the things that would be assets? So I've got kind of like a list here. There's cash type things, right? So that would be like your checking accounts, your savings accounts, things like that. This is, basically things that are cash, right?
Yep. So yeah, cash, CDs, anything of a cash nature.
Okay.
Then you have so I guess the easiest way is in what typical financial advisors would put them into 3 buckets.
Okay.
Your cash, equities, and bonds.
Okay.
Right, in terms of that side. And then, I know we're going to get into this, then the argument of the house, right? So before we jump into that, so yes, you mentioned cash. There's a lot of things that have to go into cash, like we mentioned. On the equity side, there's all of the stocks, the cryptocurrencies, any individual mutual fund, things like that. And then we've got the bonds, which is a different discussion, but it's still an asset in terms of either growth, revenue, or tax deduction if you're wealthy, which is a good strategy for them. But those are the assets, some of the classes, and you have your alternatives. You've got gold and silver, some of the commodity-based stuff. You have real estate, which can be, if it's a rental, there is a case for it to be an asset on that standpoint. But I think one of the underutilized tools in terms of an asset class in the alternative side, Matt, are a lot of the crowdfunding sites that you can put money into a real estate fund and just be a passive investor in an actively managed real estate portfolio, right? So you're not accepting the liabilities of the actual owning the property. You're just collecting a return based off of that investment. So I think since 2011, a lot of these alternative classes have opened up. So you really can do a minimal investment and really reduce your risk in these asset classes. So, but ultimately, those are your asset classes.
And those are things like some of the benefits of that. Just while we're on it, you often don't have to be an accredited investor, which opens the door for people that haven't gotten to that 200 grand a year level or $1 million in non-primary residence assets. And the investment amount is sometimes just like ridiculously low, like $10 or $50 or something like that. It's not, 100 grand, quarter mil or something like that, or, like a lot of the, like a lot of syndications will have. So they say the entry point is low and the requirements to get in are much more, the bar is lower there as well. So those are great things. What about, and we'll talk about this a little bit, like what about like a life insurance policy? What about some like antiques or something, grandma's china, where does this, are those assets?
So life insurance is definitely an asset. I think life insurance is one of the most misunderstood financial tools in the marketplace. Unfortunately, the way things are set up, it's typically seen as a product and sold as a product, not as an asset. And the reason why I say that is because at the end of the day, we're all going to die. So it literally is the best investment anybody could ever make. Structurally speaking, it can never be subject to lawsuits. Nobody can touch it. Nobody can touch it through divorce. Nobody can touch it through lawsuits. The government hasn't changed the rules on life insurance other than they changed the maximum age about 8 years ago. They've never changed the laws on life insurance. So it is a phenomenal tool if it's structured properly. The antiques I would put them as, depending as an asset, but until you sell them, it's not really actualized, right? I mean, the house burns down and everything goes down with it, then your art and the china and everything else is gone. The other side of that, which we'll get into with the house, but with art and everything else, is that your perceived value of it is not necessarily the market value of it. So it doesn't matter what you think it's worth or what you think you could sell it for unless somebody cuts you a check for it. It's just a vase.
Right. It might mean a lot to you, but it's not a lot to your balance sheet. Okay, so you add up all of those things, all of those assets. Now let's look over at some of the liabilities. The liabilities are basically the things that you owe somebody else, right? That's
Right.
For simple math, that's you owe somebody else. So assets are something that you own, but liabilities are areas where you owe something to somebody else. So those are things like maybe like credit cards fall into this category, or credit card
Right.
debt.
Well, you have to look at, I mean, I like to classify the liabilities as eroding factors of money, right? And so the two biggest eroding factors are taxes and inflation,
Okay.
right? Those are the two biggest eroding factors. Now, taxes, we can't necessarily, we can influence them, but not necessarily as a W-2 employee. Inflation changes, which is a discussion a lot of financial advisors don't have with their clients. There is the national inflation, and then there's your personal inflation, right? And it's a whole different conversation. But then you start getting into what you said, Matt, about credit cards. And I think this is also a discussion in and of itself, is the cost of interest. A lot of people, they get their credit card, they see that statement, but they don't really understand the impact that interest cost has on their life. And so they still go out and buy things with cash, and they just let this credit card just roll over. But they don't understand how that is a massive eroding factor to their wealth. But you also have interest on car loans, on those debts. I mean, for those individuals that take out personal loans, as some of these individuals, massive liability. But just the car itself depreciating is a liability. So it's not just the cost that is the liability, it's actually the thing that you're driving is the liability as well, because it's losing value as you're paying for it. And so those are some of the things that people don't really pay attention to. They just want the fancy car. They want the shiny truck and the lift kit. All of that erodes wealth. And I'm not saying not to get it, right? I'm just saying you have to understand what it means if you put your money into X versus putting your money into Y. And if you have a financial plan and that allows for that, then do that. Don't sacrifice personal well-being because, like Dave Ramsey, I don't mean to pick on Dave Ramsey, but don't live your life until everything's paid off.
We're going to pick on Dave Ramsey.
Perfect. Because he always says that. He's like, sacrifice your life. Don't do anything for 4 years. And kids can't do sports and kids can't do this. And
always pay cash. Always pay cash.
Always. And that's just it's just not realistic. But you have to understand where you leak money. And by the way, Matt, I'm not saying to be a CPA or an accountant. But at a base level, get a tool. There's lots of them. And they'll monitor your check account. And you're checking your savings or whatever the case is. And at the end of the month, you have to understand, are you surplus or are you in debt? Like really in debt? Like where is your cash flow? Balance sheets are great, Matt, both on an individual and a business standpoint. But if people don't understand how cash flows in and out of their life, then that's a challenge.
Absolutely. That's why, the we're talking about balance sheets a lot today, but the other thing we're going to talk about in another episode is going to be the cash flow and all the insights you can pull from that. This is the way I think about it. The balance sheet is a snapshot of where you are today. Cash flow is a look at like basically how money is moving in and out, and are things trending in the right direction. And then there's like the whole asset protection plan. So those, and they all kind of cover different facets. So in my book, Anti-Preneur, I talked about those three things, or at least for me, what I've used is like the best way to get insight. Balance is like where you are, balance sheet's where you are today. So you take all your assets, add them up, all your liabilities, all the things that you owe, add them up, subtract those two, and that's like the equity in your situation. But that's a snapshot as of today. So if you bought a Tesla for 60 grand, I don't know what it cost, 60 grand, 70 grand, something like that, you drive it off the lot, it drops maybe 10 grand or something like that. So let's say it's back down to 50 grand. So it's worth 50 grand now if you went to like sell it to somebody else. It's a 50 grand asset, but you have to factor in somehow this concept of that asset will decrease in value. So it's like this liability against it, that it will decrease in value over time. But it's a snapshot as of today.
Yeah. And this is where, and just like a business, Matt, right? You get paid as an individual. You have to start looking at it this way. An individual, you have that snapshot, right? And that changes whenever something major happens, or you pay down a debt or something. But if you get paid on the 1st and the 15th, and you have car payment, insurance, healthcare all coming out in the first paycheck, and you're constantly running short from the 15th or into the 15th, then that's a cash flow problem. So change the car payment to the 16th, right? Change a payment. So you have to start looking at it in 15-day increments and then 30 days. And how are those two 15-day increments in that 30-day window balanced in terms of income and cash flow out? And that's the same thing with businesses. They collect their receivables on a 45 or 60 day, but their payables are 30 days. Well, you've got a cash flow problem, right? I mean, you can't collect money 60 days out and want to pay bills tomorrow. You can't front load your month, because then, well, yeah, I mean, you could save the money from the 15th to the 30th, but the problem is the psychology with us, we'll find ways to spend it because money doesn't like to sit still.
And that's capital that's just sitting there to cover this cash flow situation that couldn't be used to fund research and development. It couldn't fund more advertising or marketing or new product development or whatever it is. So because you need that money to kind of be there to cover this very cyclical cash flow. Yeah, we could do a whole nother lesson like the woes of net 45, net 60, and
right,
and basically some of the tools that businesses use for that. Like there can be like revolving lines for against accounts, against invoices and things like that. So there's a lot of different games that people do to manage that. Okay, so on the back to the cash flow, assets minus all the liabilities, that's the equity. Do you have like a favorite tool for this? I did just a quick internet search, and like if you enter like personal balance sheet into Google, there's like a whole bunch of templates that are available. You can download those. I just downloaded a couple from some different places. They all seem to be pretty solid. Do you have a personal favorite?
I've always, for the longest times, I don't know why, I'm kind of loyal like this, Matt, and I don't like change all that much in terms of technology that I use. I use an app called Hurdler, Hurdlr, and I use it for my personal and the business side of things. And so I aggregate all my accounts, and then I just go through once a month and is this a personal expense or a business? And then I itemize that. But then also what that does for me, Matt, is that at the end of the year, I can run a report, or at the end of the month, I can run a report on how much did I spend on golf this year? How much did I spend on snow skiing this year? How is that tracking compared to the other years? Am I spending more or less? Is it a problem that I have? I don't know, right? Am I going out to the movies too much? Am I grocery shopping? Like where are the leaks in my system that I may or may not be able to shore up? I don't know. Maybe I don't want to, right? But at least that way I have the data. And this is the thing. It's not a matter of is something right or wrong. The matter is, the situation is do I have the data to make educated decisions? That's it. I mean, that's what this all boils down to. Because I heard a sales guy tell me one time, well, actually, I heard him actually tell a client, he said, how many times have you ever made a really, really good decision with no information at all? And I was like, ooh, I'm going to use that for the rest of my life. Because it's true. If you don't have the information, you can't make an educated decision. And that's what all of these apps, Rocket, Monarch, Hurdler, I think some of the banks have them now. It'll track where your money goes.
I love that in this, age of adding value, lead magnets, whatever you want to call them, that there's just so much stuff available. If anybody who's listening to this has any difficulty finding a personal balance sheet template, email me. Basically, what it does is it does two things. One is it forces you, just like you were saying, Mike, it forces you to go out and get the data that you need so you can understand what the equity in your business of you actually is. And the second thing is it gives you, once you've gotten that data, gives you a way to kind of aggregate it all up, and it does the math for you, which is really basically a bunch of additions and one subtraction, which is all pretty straightforward. But it does the math for you. You can see, what is the equity? What is my household worth? Snap the line as of today.
Right. And my pet peeve here, Matt, is that don't tell me you don't have money to invest when you're spending $200 on lattes. Like, just don't. And I'm not, because here's the kicker, is that you don't have to spend that whole $200 on investing. Just start. Start with something. But please, don't tell me you don't have time when you're watching 6 hours of NFL on a Sunday. And don't tell me you don't have money to invest when you're spending $200 on crap. I won't take it very well.
And you don't make Mike mad. You don't want to do that. Woo.
I love it.
Stay with us. We'll be right back to Thrive and Achieve. If you're looking for more information about how to help W-2 employees, check out the Amazon #1 bestseller, Anti-Preneur. It's available on Kindle and now in paperback. Now back to the show.
Welcome back. Today we're talking again to Mike Clark, a successful advisor to high net worth individuals. We're going to continue on with our discussion about the balance sheet, and we're going to look at some common misconceptions. So the first one I see is the house, right? So, they see their house on there. Kiyosaki says a house isn't actually an asset. So what's your thoughts on that?
Ooh, that's a tough one. I mean, I can see both sides of the argument. Well, I guess it's not an argument, it's just a discussion, is that it is a liability, or in terms of that it's your largest debt that you hold on the balance sheet, right? The other side is that there's equity in that home. But going back to what we mentioned earlier, is that equity is only realized if you sell the home. Until you get that check, my consideration is the home's a liability. Because you still have a massive debt, you're carrying a ton of interest. It's usually front loaded on the interest side of it. And then, there's just a massive payment that comes, especially nowadays with the interest rates. But at the end of the day, the equity doesn't mean anything until you sell it. And if we know anything, at least at our age, with 2008, 9, and 10, is that equity could go away really quick. And next thing you know, you owe more than it's worth. And then it's certainly not an asset. It's 100% a liability because you can't even sell it.
Yeah, I think as we do this, again, it's a snapshot in time, right? Things depreciate, things appreciate. You just have to use the balance sheet for what it is. So I like to put it on there as an asset, but I put an asterisk next to it. And it's a liability. The loan is a liability. If you have a mortgage on it as a liability, that's an easy peasy one. But it's an asset. But you have to put an asterisk on it because you got to live somewhere, right? I actually know some people that recently were really focused on their finances, and they went all in and said, like, we're going to move out of our house. We're going to keep it because we're got like 2.5% interest or something really small. We're going to move out. We're going to rent a place and rent out our house. So now it's an income producing, as well as appreciating asset, I think it's appreciating depending on where they live and so forth. So you have to put an asterisk next to it because you got to live somewhere.
And that's true, Matt. I mean, and then the interesting thing is that, which would be a great experiment, is to check back with them in a year and see how they're doing in terms of cash flow on that house. And then more importantly, the longevity of somebody in a rental right? The longer they stay, the better. But from personal experience, my wife has a townhouse that she was renting for a long time. And just because of certain circumstances, the tenants moved every 6 or 7 months, which means we had to go back in and patch holes, clean carpets. I mean, all these things. So at the end of that year or a year and a half, it wasn't all that profitable.
Right.
Right. So
And
you have to weigh that.
and then just from a quality of life standpoint, which has a intangible value also. If the place that they're renting from now, if the owner, landlord says like, hey, I decided I'm going to sell this because the market's really hot. I'm going to sell this. You guys got like 60 days to get out. Then now there's a quality of life issue with them also.
Right. Right. And speaking of quality of life, Matt, there is that side where, and this is what I tell clients all the time, is that real estate is great. If you're not a handyman and you don't want to be a landlord in terms of fixing things, when you get a phone call at midnight because the toilet's backed up, then maybe it's not for you. This whole perception that you grow wealth through real estate, it's not necessarily true. It has been true in the past, but with prices the way they are in homes, interest rates the way they are now, I don't know if it really pencils, right? But it goes back to the information and the data, is that you can Google spreadsheets, cash flow, rental properties, and there's dozens of spreadsheets that are templates that you can plug numbers in. But don't jump into a rental home thinking you're going to build wealth through real estate without knowing the numbers.
Right, exactly. Precious metals, gold and silver, doing really well right now. If you dumped a ton of money into that today, that might not be looking so good in a year or so. It just depends on what it could be. So, okay, some other quick questions on this. When a lot of people, when they're doing this, they see a big number in their equity at the end of the day. They maybe $1 million or so because they've got a lot of house. They put the house in there and they put their equity in the house as part of the assets, and they got some money in a 401k. A couple, 2, 3, 400 grand, something like that. Maybe $500,000 in a 401k, something like that. And they add all that up and some other stuff as well. Their Tesla, which is still worth 50 grand. They add all this up and they look like, oh, I've got equity of $1 million. I'm a millionaire. I'm rocking it, man. Quit.
Yeah. Right.
Right. Is that obviously that's a little bit of a misleading picture. What are your thoughts on that? I'm sure you've got a bunch of examples of folks, or don't use their names, obviously, but like situations like that.
Well, I mean, I think the big example, and Matt, I don't care what side of political fence people fall on, but one of the biggest things is Elon Musk, right? He's worth X. Like he's worth it as if he has $1 billion in his pocket, right? And I think this is the biggest misconception, is you mentioned it earlier. It's just a snapshot. It gives you a perspective of what you own and what you owe. That's what that is, what you own and what you owe. It does not give you a look into your actual cash flow, because we know that there are very, very wealthy people that are living paycheck to paycheck, and there are very wealthy people that are cash poor. And that could be by design. I don't know their situations, but I think that is the biggest misconception, especially in the media these days, is so-and-so is worth X, right? They're worth $1 billion, and that's not fair, right? Or whatever, like it doesn't matter. Like I said, it doesn't matter what side of the fence you're on. It doesn't mean they have that money. It's just on a piece of paper as an asset. They still have to go sell that asset if they want to actualize the money and realize that income. But even then, there's still taxes and all kinds of eroding factors to that. But I think that's the biggest misconception, Matt, when it comes to the balance sheet and I think you said it great. It's just a snapshot. It's just, what do you own and what do you owe? That's it.
Excellent point. Okay. $300 watch, asset, not an asset?
So the interesting question, or the interesting part of that question, Matt, is now you've got people actually buying watches and flipping them. Now, I don't know, which is also picking on these individuals, because in order to learn this system, you have to buy their coaching program at $5 grand. So I don't know. But I guess the harder answer to that question is it depends on the watch. Like if it's a I don't know. I don't know what these high-end watches are called, but if you find a high-end watch that appreciates over 2 or 3 years historically, and you buy it for $300, and in 3 or 4 years you can sell it for 5 or 6, well, then that may be considered an asset. I don't know. I mean, some of these guys are making 6 figures a year just buying and selling watches.
At least that's what they tell you on the success story
That is
part
so
of
true.
their video sales letter, right?
Yeah, yeah, and they've got 6 or 7 guys that say that like, I've made this, and yeah, I don't know if it's true. I'm not buying this stuff, but
Right.
yeah,
Yeah.
we'll
I
see.
think
I
it's
mean, but there are watches out there that do appreciate in value. I mean, I'll tell you, my dad bought a Rado 1969, I think for like $300, and I've taken into jewelry stores, and it's worth $600 or $700 now. And he didn't buy it for the appreciation; he just bought it as a gift to himself, and he's kept it this whole time. Well, now I own it, but so who knows? I mean, is that a massive appreciation in, I don't know, 60 years? Probably not, but it can happen.
trying to do my rule of 72s on that
It's not good, man. It's not
It's
good.
not good. Yeah, it's the follow-up question would be like, okay, a 30 grand watch, and I think that when we start thinking about those, it's really gets into the kind of the classic macroeconomic concepts of supply and demand, right?
Right.
If you're buying something today, and you'll be able to buy that same thing for the same price tomorrow, the same thing for the same price next year, new, then and it's basically the same as it's some aspect of being commoditized, then probably not that much of a it may be still an asset. It may not be worth what even on the balance sheet, what you paid for it. Some other things that are much more rare, the Rolex only makes a certain number of rose gold day dates, that are with a green, emerald green face every year or something like that. So
Right. I mean,
they might not
let's
make
put it
that
this way,
every year,
Matt.
so-
If you can go into a Macy's or a Nordstrom and buy a watch, $300, $400, $500, it's probably not going to appreciate in value.
Right.
Like, let's just be honest about that.
Yep. Exactly. Okay. All right, everyone. We are again talking to Mike Clark, successful business person turned advisor to high net worth individuals. We've been talking about a lot of balance sheet stuff. We've gone really, really deep on that. Let's do a couple quick advanced topics. What are some of the mistakes that you've seen? So other than overvaluing your house, what are the biggest mistakes people make in creating a balance sheet?
Not understanding what should go on there. I mean, that's the first thing, but just not understanding what the data means. Like, it's one thing to put it on there, and it's one thing to have a template. But if you don't know how to extrapolate the data needed to make educated decisions, then it's just numbers on a spreadsheet, right? The other part is people, and I see this quite often, is they don't really understand what they have in terms of assets and liabilities. They're like, oh, I forgot about that. Oh, I forgot about that. Okay, well, you need to know what you have. And the second part about that is they don't really understand the value that it holds. They just go off of their emotional kind of guide or gauge in terms of what they think it's worth. But if they did a little digging, they would find out that it's often not worth nearly as what they thought it was. And I think those are the two biggest, those are the two mistakes that people have when it comes to balance sheets.
Yeah, go to realtor.com, go on eBay, go on whatever to find out what you could buy that for. Is there kind of like a yardstick? So people like to have metrics and so forth with things. Is there any rule of thumb or yardstick that people use here for like the equity, the assets minus liabilities? What should that be versus how many years they expect to continue to be working at their current income level or greater? So is there like any sort of like yardsticks or rules of thumb? Like if you've got 20 years left in the workplace or 20 years before you're 65, you should have on track as having equity equal to such and such amount. Is there a kind of a rule of thumb with that you professionals use?
Matt, I love that you asked that question. And there's a lot of, and I say that for a couple reasons. The first is that there's a lot of things online that say, you have to have 2 million in the bank to retire. You need 5 million in the bank to retire. And then on the other side, you and I hear this quite a bit in terms of generational wealth, right? And I think what both perspectives absolutely miss is a critical question, which is, what does wealth mean to you? Like, what does that vision look like? Because I follow some principles that I learned from a mentor of mine when I first moved to Utah, and it's dollars follow value. And then another one is exchange creates wealth. So let's just say I don't have $1 million, but I've accumulated all of this knowledge in my life to be better financially sound in terms of making decisions. And then that generational wealth could just be a matter of me transferring that knowledge to my heirs so they can make better decisions earlier on. And then eventually that will happen in terms of actual dollar amounts, right? But I think the biggest problem, and we just did a class on this, is you have to sit down as an individual, as a business owner, as a parent, and define what that means to you. What does wealth mean to you? What is the utility of money for you? What do you want that money to do, go, and grow towards? Because you could have 2 or 3 million in the bank at retirement, but you could still be without purpose. Like just sit there and just let the money die, right? But then there are people that have 500 or 600,000 that understand that they can utilize that over whatever that retirement looks like. Because that's the other question, Matt. Not only just what does wealth mean, what does money mean, but what does retirement look like? Most people have never sat down and actually defined that. And like, okay, if I live to 80, what does that look like? If I live to 90, what does that look like? If I live to 100, what does that look like? What do I want in that life? Do I want to travel? Do I want to spend time with grandkids? Do I want to go sit in the park, play golf? Like, what does that mean to you? And then reverse engineer that, map it out, and then grow towards that goal versus just saying, I want $1 million. Okay, what does that mean? Right? So I think there's a lot of, media distorts a lot of things, but I think that's the bigger question in terms of getting clarity on that for an individual versus saying, hey, this is my yardstick, that's my benchmark, I need $1 million.
No, that's spot on. What we have done is we have equated money to being the end goal.
Yes.
As opposed to a tool that can help us live our lives and achieve our dreams.
That's it. But you have to be clear on what that dream is. You have to be clear on what that vision is. And then you have to communicate with your family and have a family mission. Like, this is where mom and dad are going, right? And this is how we're going to help you guys do what you guys want to do. But it has to be a clear vision of that. Absolutely.
Awesome. Mike, you have given us a ton of useful advice and a bunch of things to think about. How can people get in touch with you?
Super easy. I'm all over LinkedIn. Protection Point Advisors. You can go to protectionpointadvisors.com. One of the ways that we build financial teams for individuals is through the National Referral Network, which is nrnamerica.com. So either one of those platforms, you can reach me. But I am on LinkedIn with Mike Clark, MBA, I think is my tagline on there. So all kinds of ways to get a hold of me.
Awesome. And there's 2 Mike Clarks at Protection Point, right? There's like you and that other guy.
The other guy. Yeah, the other guy just happens to be the co-founder. But yes, it's very odd during staff meetings when they say Mike and then they say Clark and we both look.
Nice. Mike, thank you so much. This has been fantastic. Oh my gosh, ton of insight, ton of useful stuff. I think we all took about 20 pages of notes here today. So thank you so much. Absolutely been fantastic.
Thank you, Matt. I always look, first and foremost, I think I appreciate the friendship, love what you're doing with the platform, and look forward to supporting you any way that I can to grow this. So thank you.
Awesome. Take care, guys.